recording now. So does anyone want to do like a specific handout, either handout 2 or 6? Maybe you can start with handout 2, Jenny.
Sure.
Yeah.
For some reason I can't see the chat though, so can you tell me? When someone says something. Okay, so for handout 2, what you're gonna start by doing is you're going to record the initial transaction. So if you're looking at handout 2, it'll be the top portion. If you see like what it says the Happy Retail Store recorded the following transactions during 2020. And then afterwards, that's when you'll make the adjusting journal entries, which are the ones on the bottom. So for the first line for January 25th, what you're going to do is put the date. And then if you read it, it says purchase $600 of office supplies. So the initial journal entry for that would be supplies expense.
No, it's supplies.
Supplies for 600. And then you would credit
Yeah, cash by 600. Yeah.
No. Oh yeah, it is. Oh, you already wrote it. Thanks, David. So this would be your initial journal entry to record this transaction. So then that's it for that one actually.
Yeah.
And then on February 1st, rented a warehouse from Alpha Company paying 1 year's rent of $4,800 in advance. And then it says that recorded the $4,800 as a payment to rent expense. So you know that if they pay for 1 year in advance, that would be considered a prepaid rent. But in this case, the accountant, they recorded it as a rent expense. So the adjusting journal entry, just to let you know ahead of time, that would be a unusual journal entry. So for this one, it'll be rent expense for $4,800. And then your credit would be cash for $4,800 because you paid it in full.
Yeah, so for those of you who just came in, we're doing handout 2 right now, so which is adjusting journal entries. So what we're doing right now is we're recording first the transactions that happened during the year. So this so what we're doing right now is not what you're gonna answer for the test. We're just doing this so that later on when we're doing the adjusting journal entries, you can have a better comparison of what's happening. So yeah, just a heads up.
So moving on, this will be your journal entry for February 1st. For March 1st, you borrowed $20,000 from the bank, signing a 1 year note at an annual interest rate of 12%. So you're gonna increase your cash by that amount. And then you're gonna credit a liability, which is loans payable or accounts payable.
Yeah, loans, notes payable.
Can you change it, please?
By 20,000.
Can you tell the difference between a note and a loan or account payable?
I think like for here, because it says that the 20,000 was borrowed from the bank, we're just assuming that it was like a promissory note or some, or like those kind of financial instruments where it accrues interest, because typically when you borrow money from the bank, you'll get notes, right?
Mm-hmm.
Compared to like accounts payable.
Sorry, yesterday Jose told me that the difference is the notes payable, you would include if you would get or pay taxes. I mean, sorry, not taxes, interest.
Yeah, there's also one difference for the accounts payable and notes payable. But accounts payable is typically used if you're purchasing like merchandise or any type of like supplies on account or on credit.
Oh
But
no,
yeah, that's also like a good point. Thank you for bringing it up, Marie.
no, yes, because I was questioning if how you know if it was notes payable or loan payable, and he answered with that if it's notes payable, then you should pay or pay back interest. If it's loan payable, then you just got the loan without interest.
So between notes and loans, it depends on the duration of your payable too. So I think notes payable, it's one or the other. It's like greater or less than 5 years, right, Raymond? And one is like less than 1 year.
Actually, like they're pretty much the same in that both of them accrue interest. So
Okay.
what's like one maybe like for example like loans payable like what Jenny said, it can last longer in terms of duration where when as compared to like notes where it's more on like most of them are like in short term.
Okay then.
Yeah.
Okay.
Yeah,
Thank you.
so both of them you're still gonna have to calculate interest and interest payable.
And so
Okay.
Everyone good?
yeah, I think we're good.
Thank you.
Mhm.
So for May 1st, you purchased office equipment for $30,000, paying $6,000 down and signing a 2-year 12% annual rate note payable for the balance. The office equipment was expected to have a useful life of 10 years and salvage value of $3,000. Straight line depreciation is used. So you bought equipment, so you're going to increase your assets for $30,000. And then it says here that you only paid $6,000 down. So you would credit cash to decrease cash for this amount. But then for your other to make it balance, it'll be a 2-year annual rate note payable. So here it says indicates that it's a note payable for the remaining, correct?
Yeah.
Am I reading that right?
Yeah, the remaining balance, which is 24,000.
Yeah. Loss equipment is expected to have a useful life of 10 years. The rest of it will be the adjusting entry, right?
Yes.
So this is your initial entry for that. Then for July 1st, you purchased a 3-year comprehensive insurance policy for $1,200. So that, since you're paying it for the future for an additional 3 years, it will be prepaid insurance for $1,200. And then you would credit cash for $1,200. So that's that one for that. And for August 1st, you sold land for $18,000. The purchaser made a $6,000 down payment and signed a 1-year 10% note for the balance. So this one is kind of like May 1st. So you sold land, so that would make it, you paid the purchaser made a $6,000, and then so this one you gain $6,000 in cash initially because they only paid $6,000, and then the remainder for this one, since
wait, hold on a second. Oh yeah.
Right, they signed a 1-year note for a balance, so that would be
Notes receivable. Yeah, notes receivable.
No, it wouldn't be a
it'll
account
be a
account receivable.
because they said on the
It's
They said on
actually
the
like,
problem it says notes.
no, yeah. So we can't really use accounts receivable since in the problem it says that the remaining was signed with a 10% note for the 10% note from the bank. So instead of using accounts receivable, we're gonna use notes receivable. So most for the most part, we're using accounts receivable when we're doing like regular transactions, such as um, selling merchandise on credit, or maybe just yeah, like like regular transactions on credit. We're doing regular transactions on credit, so that could count as accounts receivable. But in this case, since it indicated that the remainder was paid through notes, so that's why it's notes receivable. And for October 1st, we are, wait, let me, someone,
What happened?
yeah, we're recording this, and we can definitely show you guys, forward you guys the recording either through email, or maybe you can send you guys a link to the videos.
Does anyone have any questions so far? No. Okay. So for your last initial entry for October 1st, you rented a portion of the retail floor space to a florist for $300 per month.
Yeah, you can type in your emails on the chat
Collecting
box.
8 months rent in advance, recording the receipt as a rent revenue. So this one is also going to be an unusual adjusting journal entry. So you're renting a space to a florist, so that indicates that you're receiving money. So it'll be rent revenue for $2,400, and then you'll be crediting cash $2,400. So these will be all of your initial journal entries. So now we're going to move on to the bottom portion, which is the adjusting journal entries.
All right, so for those of you who just came in, oh, what happened?
You did that.
Okay, so for those of you who just came in, right now we're gonna do the adjusting journal entries, which would be your final answer for your exam. So what we're doing here, the reason why we recorded these transactions before doing the adjusting journal entries, is to give just to give you guys like a better overview of what's going on. And so for the adjusting journal entries, we're gonna do it by the order of the transaction. So if you look at the supplies, and if you look at the additional information available below, which is no,
Should you do it like one by one and just like find the initial journal entry?
like do it one by one.
Yeah, so like 1, 2, 3, 4. So that way you kind of like explain as like which one you're looking for, or no?
Yeah, we can do that.
Okay.
Let me just admit the people who are coming in. So we're just gonna do each adjustment up by number instead. And so if you look at the additional, we're gonna begin in the additional information, number 1.
So we're
So
on the bottom portion
yeah,
of
we're in the
Handout
bottom
too.
portion. So for number 1, it says that the property taxes are due on December 1st, and the company has not paid or recorded those property taxes, which is worth $4,000. And so to record this adjustment, we just have to debit property tax expense, which is 4,000, and then credit the liability part, which is property tax payable 4,000. And similarly, for number 2, we have a utility bill of 500 that wasn't paid yet or recorded, and so our debit will be utilities expense, which is 500, and then utilities payable, which is 500. And for number 3, we have to record the accrued salaries, which is 1,200, and so salaries expense.
So like if you are kind of like confused on how he knows it's expense or like a payable, so if you like really read the questions, if it indicates that it has not been paid or recorded, that's indicating an adjusting journal entry for a payable. That's all I have to say.
And so for number 4, if you read the information, it says the office supplies account had a beginning balance of 300 and an ending balance of 150. So if you look at the transaction that we recorded on January 25th, this has something to do with the information on number 4, and so just to give you guys like.
So you're gonna need the initial journal entry that happened on the 25th to make this adjusting entry.
Yeah. And so to recognize the supplies that was used in 2020, we have to account for the beginning balance, which is 300, and the amount purchased, which is 600, as well as the ending balance, which is 150, to get the amount of supplies used. So basically, we can summarize it with this formula. Beginning balance plus purchase minus ending balance. So after doing this, we get 750 for the supplies expense. So
Does anyone have any questions on that?
Yeah, I think
Please also reply in the chat box.
Mm-hmm.
No questions, okay.
And so for our AJE, it will be supplies expense 750, and then credit supplies by 750. And for so this is the number 4.
Can I please bother you again on explaining how you got the end balance?
For the supplies?
Yes.
So if you look, go ahead, Jenny.
So if you look at number 4 on the bottom, it says the office supplies account had a balance of $300 on January 1st. So that's your beginning balance, which is 300. And then throughout the year, on January 25th, you bought 600. So that's why you add the 600. So if you read continue reading on number 4. A physical account on December 31st showed $150 of office supplies on hand, which means the 150 indicates your ending balance after you've used or like expensed or used everything throughout the year, because it happened on December 31st.
So if in case you guys are wondering, the beginning and ending balance are always given in the problem.
So, Jean, does that make sense? Or would you like further explanation? Jean?
Oh, I forgot I'm on mute. Sorry. Yes. There's more explanation. Yes, please.
Okay, so to get 150 here, right, if you were to read the problem, it says a physical account on December 31st showed $150 of supplies on hand, which means the $150, since it's on hand, it means that you still have $150 worth of supplies that you have not used yet, hence why it's still within your warehouse or within your operating store. So if it were to say like it showed, this is the physical count of your inventory, by the way. So it means that, let's say like I worked at like Ralph's, and we bought in, or beginning on, let's say like tomatoes lasted a whole year, right? So let's say that we had $300 worth of tomatoes at the beginning of the year, which is January 1st. So throughout the entire year, we bought $600 of tomatoes, right? So let's say we're making hamburgers at Ralph's, and let's say that by the end of the year on December 31st, we counted the number of tomatoes that we had left, and it equaled $150. So because we didn't record how many tomatoes that we used throughout the entirety of the year, we just know that we had a beginning balance of $300 of tomatoes on January 1st, and then we also purchased $600 worth of tomatoes throughout the entire year. So since we know the ending balance, which is how many tomatoes we had at the ending of the year, we have to find how many tomatoes we used, which is where the 750 is. Does that make sense?
Yeah. If we have the beginning as 300, sorry, had
No, it's
about
okay.
100. So if we have 300 and we purchased the 600, but it's saying that we have 150 on hand.
Yeah.
Why are we subtracting it?
So that's because you know your ending balance. You know that you still have $150 of the $900 worth of tomatoes that you had. So you're trying to find the expense. It's kind of like algebra.
Okay, so if you think of it this way, if you look at this T account here, we had a beginning balance of 300, right?
Mm-hmm.
And we purchased an additional 600, right?
Mm-hmm.
And so this totals to 900. And so if we have this information right here, which is 150, so let's just write this down. So if we have 900 in total, so the question is, how much did we use? So let's say, so how much did we use to come up to this amount of 150? So how much from the 900 did we use to come up to 150?
Okay. I think I was stuck on looking at how much do we have, but I get it.
Oh, no, yeah, how much do we use? So from 900 we use 750. That's why our ending right here is 150.
Okay, thank you.
Just so you guys know, Raymond is he's a lot better at explaining stuff. So if I come up with like weird explanations and examples, just
No,
bear
you're
with
good.
me.
So,
Because I did expense, and I was like, oh, it's not what we have, it's what we expensed.
yeah.
Yes. Correct.
And so for number 5, so now we're going back to the additional information that was given to us below at the bottom section of the handout. So in number 5, it says that the building account and equipment account had balances of 200 and 130, and the building are expected to have a salvage value of 16,000, while the equipment salvage value is 4,000, and useful life for those like assets is 20 years for the building and 10 years for the equipment. And so this like adjusting journal entry for number 5 is just basically depreciation. So if you recall the formula for depreciation, which is
Equipment minus salvage value, right?
the cost
Cost.
cost
Equipment cost minus salvage value divided by the number of useful
value
years.
divided by useful life.
Yeah.
Yeah,
Which
so
is
for
number
so
of
for
years.
so for this one, let's just do it step by step. We can do the buildings first. So for the building, we have so we're looking for this formula right here is for the annual depreciation. So for the building,
so the building's cost, right? You read the problem, it says it has it's worth 200,000. Wait, why'd you do it like that? Or here, you can just do that one, I'll do the next one.
okay. So for the building, it says that your building's cost is 200,000, and the salvage value is 16,000. So all of these numbers are given. Divided by the useful life, which is 20 years.
Yeah.
And so this will equal to how much?
9,200.
Thank you. 9,200. And for you want to do the second one, Johnny? Equipment?
Okay. So for your equipment, so the problem it says that your equipment is worth 130,000, which is your equipment cost. So then you would subtract the salvage value, which is 4,000, and then you would divide that by the number of useful years, which is what?
10.
And that would equal
12,600.
Thank you. So does anybody have questions on how we got these two numbers?
We're good.
Okay. Carry on.
And so for the adjusting journal entry, we can actually like do it separately, or we can combine the two. We can combine the two depreciation expense. So we'll just like do it separate so that you guys will it will be much clearer for you. So for the depreciation expense, so we're doing the building first. So the building has a depreciation expense of 9,200 and an accumulated depreciation of 9,200. And for the equipment, depreciation expense of 12,600 and accumulated depreciation of 12,600. So this is how we record the adjusting journal entry for number 5. And for number 6, it's like pretty similar to the first adjusting journal entries that we did. So so number 6, it says income tax of 7,500 is payable on March 5th, 2021. So as what Jenny said earlier, to determine whether we're going to use the payables, just keep in mind that if we haven't paid the transaction yet, then it is going to be recognized as a payable. So this, for number 6, it's income tax expense, which is 7,500. And so since we haven't paid this since we haven't paid this income tax yet, we're gonna record this as a payable, income tax payable, which is 7,500. Yeah. Jenny,
Does everyone, huh?
Oh no.
Does everyone know like the basic adjusting journal entry, like accounts or entries? So it's usually expense. We're gonna do the payable. And keep this in mind because I made this mistake on my my midterm. So you're never ever going to, in an adjusting journal entry, you're never going to touch the cash account. Never touch cash in adjusting journal entries. Like ever. So if you're thinking that, if you're reading a problem and you think that you should adjust a cash account, never. That's wrong. Expense payable, and then depreciation expense. If you're doing depreciation, then this will be accumulated depreciation. What are some other ones, Raymond? Oh, like unusual entries.
We haven't really gone over that yet.
Okay.
So what we did for this, so what we just did is the adjusting journal entries for the information at the bottom of your handout. So now we're gonna do the adjusting journal entries for the transactions that we recorded earlier. So why would you never adjust the cash account? You want to answer this?
Huh?
Do you want to answer Susan's question? She's asking, why would you never adjust the cash account?
Oh. So when you're adjusting entries, right? From my understanding, Professor Weiss told us that, and when you're adjusting entries, it's you're adjusting the accounts that you've already made that already have values in it. So I know that you may think that cash has a value in it, but cash is only supposed to be increased or decreased when you're either paying for something or when you're receiving income. So that's like a debit and a credit. But when you're adjusting entries, the reason why you don't touch the cash account is because you're adjusting it at the end of the year to either a payable or you're recognizing an expense that you haven't paid yet. So like if you were to read like the problems and stuff, like I said earlier, it never has or not if you see that like it hasn't been paid or something, it indicates a payable. That's just how I understand it. Yeah. Maybe can you expand on that if you have any other ideas?
I think because cash, like whenever we wait, let me think.
Because like I understand cash as like you're only gonna touch it if you were to like I said, like increase in income or like receive income, or if you're going to pay for something. That's only when you're gonna pay for or touch the cash account.
Yeah.
Just like in like some of our initial entries, I think some of them had cash in it.
Right.
That's
So
because you paid for it upfront.
okay, so it's never, so, and that makes sense. So it's never then an adjusting journal entry.
Yeah.
Yes.
That makes sense. The way you explained it was perfect. That makes sense.
Oh, okay.
So you want to do February 1st?
February 1st?
Mm-hmm.
Sure. So for February 1st, you're rented a warehouse from Alpha, paying 1 year of rent in advance recording. So like I said earlier, this one is going to be an unusual entry because you recorded the entire year's worth as a rent expense when it should have been a prepaid. So what your account looks like right now for the rent expense, it's 4,800. But if you look at the number of months, right? From February 1st, February, March, April, May, June, July, August, September, October, November, December, 11 months. So if you want to figure out the monthly amount of this 4,800, you're going to do 4,800 divided by 12, which is 400.
Mm-hmm.
So counting the months, right, it's only 11 months have elapsed, which means that you paid for an extra month's worth of rent to be carried on to the next year. So this is the monthly amount, the 400. So if you do 400 times 400 per month times 11 months that have elapsed from February to December, that equals 4,400. So this number should be what you recognize as your rent expense for the year. So your adjusting entry would be prepaid rent, which is what's left over, which is your $400, and then your rent expense would be 400. So what I did here is you're going to decrease the rent expense by 400. So then your remainder after that is, I'm trying to make it look nicer for you guys. So what you're going to recognize for the year is 4,400. Does that make sense? Wait, what happened to my, oh no, it's there.
Yeah, I think Professor Weiss calls this like term as unexpensing. But yeah, this is what's basically what's going on here. We're just recognizing the amount that wasn't used yet, because for the entire year we didn't really use 4,800.
I'm just showing
The T accounts.
So then your prepaid rent for the next year would have a beginning balance of 400 already. Does that make sense? I can't see the chat. Does anyone see anything?
Yeah, if so, you can see the chat.
No. I think it's when if I have like control, I can't see the chat for some reason.
So for March 1st, we borrowed money from the bank, right? So of course that note would accrue interest over time. So 20,000. So we have a note of 20,000. I mean, we have a balance of 20,000, and our interest is 12%. So just calculate 30,000. So we first need to get like our annual interest. Annual interest. Okay, computing the principal times rate.
Yeah.
So in this problem, our principal is 20,000 times 12%. So what happened?
Sorry.
So since this amount is this 2,400. Wait, what's happening there? So since this 2,400 is good for 1 year, and we got the note on March 1st, we have to prorate it. So that means we have to
You have to only recognize the number of months that you should be paying interest for the year.
So from March 1st to December, that's gonna be 10 months. So 10 over 12, which is 1,000. 2,000. So from March 1st, so what this number means is that from March 1st to December 31st, we earned a 2,000 interest. So for our adjusting journal entry, it's gonna be interest expense 2,000. And since we haven't paid this yet, so it's gonna be interest payable 2,000. So if you
Do you
guys
have any questions? I don't know why I can't see the chat box.
No, if you see the green bar that says like stop, that has the stop sharing option,
Oh yeah.
and then just like put your cursor on top of that, and then it will show you like an option to view the chat box. So for May 1st, we actually have to record 2 adjusting journal entries here. So the first one, it has to do with the notes. So let's do the notes first. It's kind of like similar to the one that we did previously. So for the note, we have a $24,000 note with an interest of 12%. 12%. And so since this interest is only good for is good for the entire year, we have to only recognize the interest that was earned from May to December. So it's going to 2,880 by so from May to December, we have how many months? 8 months.
May, June, July, August. Yeah, 8 months.
8 months to get the amount of 1,920. So similar to this, we're debiting interest expense, just 1,920, and credit interest payable, 1,920. And so, so for the second journal entry, we have to adjust the depreciation since we bought an equipment, and equipment depreciates over time. We have to record the depreciation from May to December. And so, as you recall, our formula for depreciation is annual depreciation equals equipment cost minus salvage value over useful life. So to get the depreciation, our equipment cost is 30,000 minus the salvage value of 3,000 divided by the 10 years useful life. So this is what we have to prorate. We have to prorate it, right?
Should be 2,700, no? 2,700?
Yes.
Yeah.
So this amount we have to prorate it. So from May to December, it's
8
months. And give me 1,800.
Yes.
Yeah. So to record the depreciation is going to be depreciation expense, which is 1,800. And then accumulated depreciation credit. Does any one of you have a question about what we did here?
Don't be shy.
Where did you get the 3,000 from?
Oh,
That's the
3,000.
salvage value. So I'm pretty sure that on like your exam and stuff, if there is a salvage value, it will be indicated on the problem. But if you read on May 1st, the initial transaction, it says that the office equipment is expected to have a useful life of 10 years and a salvage value of 3,000. So you always want to reduce your salvage value before calculating your annual depreciation.
Okay, thank you.
So for July 1st, we bought an insurance policy for 3 years worth 1,200. So to get the annual insurance,
You divide by 3.
yeah, we divided by 3 because this 1,200 is good for 3 years. So 1,200 divided by 3 years.
400.
Yeah, 400 per year.
Mm-hmm.
And so since we only bought this insurance on July 1st, we didn't really use the entire 400 for the year of 2020. And so we only have to recognize the insurance that we used from July to December. And so it's gonna be so
6
we're
months.
multiplying this by 6 months.
Yeah. 6 over 12. So it'll be 200.
So for our adjusting journal entry, we're gonna recognize the expense. So insurance expense of 200, and we're gonna have to credit the prepaid insurance for 200.
Insurance, not expense.
Oh, prepaid. Yeah, prepaid. Yeah, prepaid insurance by 200. Is
Anyone
this
have
clear?
questions?
I think we can proceed
Mm.
to.
Proceed. So for August 1st, you sold land for $18,000, but then the purchaser made a $6,000 down payment and signed a 1-year lease. A 1-year 10% note for the balance. So in this case, you're going to be receiving the interest. So it'll be interest receivable and interest revenue, because you're issuing the note. So like Raymond said earlier, for your to figure out the annual interest, you're going to take your principal times your rate. In this case, it'll be 12,000 times 10%, which is what? And then you're going to multiply that by how many months have elapsed from August 1st. So August, September, October, November, December. So it'll be 5 over 12, which is
500.
500. So then your interest receivable would be 500, and then your revenue would also be 500. And then moving on to the very last one. Rented a portion of the retail floors to the florist for $300 per month, collecting 8 months of rent in advance. Record the $2,400 as a rent revenue. So this is also going to be an unusual entry. So because you recorded the $2,400 for the full 8 months in advance, what your calculation would be the total rent revenue divided by the number of months that it would elapse or be good for. So that would be 2,400 divided by 8 months, which I already gave you $300 per month. So from October 1st to December 31st, that's a total of 3 months. So you would take the 300 and you would multiply it by 3, which equals 900. So because you recorded it as a rent revenue, you would have to record the remaining $1,500 as unearned because you haven't earned this amount yet. So you would have to Debit? Yeah, no. Earned revenue is a liability.
Debit revenue.
Wait, why are you debiting revenue?
Oh,
Aren't you increasing it?
yeah. I think we made an error. Okay.
Yeah, so he's right. So you have to decrease your rent revenue by 1,500, and then you'd have to increase your liability, which would be unearned revenue.
So yeah, this completes our adjusting journal entry for Handout 2. If you guys have any questions regarding what we just went over, feel free to type in the chat box. Or if you guys want to focus on a certain transactions or the adjustments that we did, we can also do that.
Yeah, does anyone have any questions on a specific number? How we got certain numbers? What the formulas are?
I'm a little confused on how the top section connects to the bottom section, because at first I thought that's what we were doing. But then we went back and actually did the adjusting journal entries. So where does the bottom section come in?
So for the bottom section, this is actually what we did first earlier. So if you see like the numbers, so you're referring to the additional information, right, G?
Yeah. Why is it important? Because as we've done the adjusting journal entries, we haven't really come back to it.
We actually did it. We actually did it first. Like those like additional information, we did it first. So if you look at number 1, it says property taxes are due on December 1st, and the company has not paid or recorded its 4,000 property taxes for 2020. And so this actually, so what we did here is related to that, it's related to number 1 for the additional information. So this adjusting journal entry here, property tax expense debit and then property tax payable, reflects the number 1 information. This that makes sense.
I don't see how.
So for number 1 on the bottom portion, the additional information, you're just making this adjusting journal entry. You're not touching any other account. But if you were to look at, which number was it? Number 4. So if you were to read number 4, the office supplies account had a balance of 300, a physical account had 150. That's when you would need your top portion, because you purchased supplies, so you would need to know how many supplies that you how many supplies or amounts of supplies that you gained during the year to make that adjusting entry.
So did we use all the information or just some of it? Because like salaries, did we do an adjusting journal entry for salaries?
Oh, did we skip that one?
Are you referring to number 3?
Oh no, it's here. Yes.
So when we did that, did we do later on an adjusting journal entry?
No, so this would be the adjusting entry. because you accrued the salaries throughout the year, but you have not paid for it. So you have to recognize it in your books that you still have to pay your workers $1,200 for the year.
Mhm. Okay.
Does that make sense? Let us know if it doesn't make sense.
Yeah, it makes sense. It's just the top and the bottom. Like everything connected. I thought it was.
I'm sorry, what was that again? Jean, you were kind of cut off in the middle.
And I was saying I thought like the bottom area was connected to the top, but it's I guess it's just some of the information and the bottom still it's adjusting. I
Um,
don't know.
so the bottom portion, yeah, so you're correct. So only some of the numbers would reflect back to the top portion, but that's only if the information is needed.
Okay. So it's about 3 different things that we do. We first record the transactions, the ones that have the dates, and then we go to the bottom and do those, and then go do the adjusting journal entries. It's 3 steps, if I'm
Yes,
correctly.
but on your exam, you're only going to be focusing, these would be your answers. The adjusting journal entry section would be your answers. But yeah, so if you do have any information that like, that's kind of like the first one, like it tells you that whichever company purchased $600 amount and it gave you the ending amount, you're going to need to follow these steps.
Okay. Thank you.
So your answer, what I meant on the exam was that your answer would be this. Or the supplies expense and the supplies. It wouldn't be this.
Got it. Makes a little more sense now. Thank you.
So sorry, just to be clear, the first adjusting journal entry would be the answer for both number 1 and January 25th, or how would that one work?
This one?
Yeah.
So this one, yeah, so this is your initial journal entry to record what you purchased, but then this is to recognize how much you used throughout the year. So for number 4, this one responds, or it corresponds to number 4 on the bottom of the handout. But you're using January 25th on the top to calculate this.
Yes, I know we combined the information. So,
Mhm.
but that the debit supplies expense for 750 and credit supplies for 750, would that be an answer for January 25th and number 4? Like we would
Yeah.
use that answer twice?
No, that will be your answer for both
Number
of the information. Yeah, for the 25th and the number 4.
So yeah, we would use the answer twice then.
No, you only
You
have
use the
to.
information twice.
Oh, okay.
Yeah.
Yeah, but to answer your question, this will be the answer to number 4.
Okay. Okay then. Thank you.
Mhm.
So do you wanna?
Anyone? Huh?
Oh, I was just gonna say if I know that some of you just came in, but so for those of you who we just want to let you know that we just finished handout 2, and so if it's totally up to you guys if you want us to proceed to handout 6 or redo handout 2 all over again.
Are there any specific problems that any of you
Go ahead,
want us to go over or need more clarification on?
Mauritius raising his hand.
Oh, Mauricio? How do you see that?
Do you have any question, Mauricio? Yeah, we're doing. Yeah, we can do Handout 6. So, Jenny, we'll just proceed to Handout 6. Don't worry. So for Handout 6, we're doing statement of cash flows. So if you remember, we did cash. You guys did like cash flow accrual in your previous handout, and so basically this statement of cash flow is just like the opposite of what you're doing. So we're converting accrual to cash this time. So I think my best advice that I could give you when doing Handout 6 is to just really get yourself familiar with the template, because like, to be honest, like knowing that template would like memorizing like the template would make the entire process easier for you guys, because like statement of cash flow is just basically based on format. So yeah, like Jenny, do you have any like tips before we start?
Also, like, don't rely on memorizing it too. Like, understand why you're doing it, so that way you don't like forget midway, or like start questioning why you're just like subtracting this number or taking this number and not the other number. So I feel like understanding the concept.
Yeah, but for sure, make sure that you're familiar with the format, because Professor Wise, I believe, is not giving any template for the statement of cash flows. Like from our last test, he didn't give any, right?
No, we had to. I think we had to create the entire thing ourselves.
Yeah.
So
that's the one.
I actually don't know what your test looks like. I don't know if there's going to be written portions or if it's all multiple choice. I actually don't know. So
I think some of them are going to be multiple choice, and then some of them we're going to need to input information ourselves.
but you don't have to create like an entire like cash flow statement, right?
It's hard to say because the sample exam just gave 4 questions and they were either multiple choice or you insert like a number. So I can't say about a format.
It was all multiple choice, and you put in like 3 letters for the under, over, or like nothing.
Oh, okay. Oh, okay. So that should be that's a lot easier than ours.
Well, yeah, that's easy for the small stuff, but we're asking for the big stuff, like for the entire balance sheet or for the cash flow. Would we have to type that out, or would that also be multiple choice? Like, I pick down goes first, like the sales would go first, or would we have to write that out with the number? And is if it's one by one, or if we do it all at once, the entire balance sheet or cash flow, because he said that the questions were going to be one by one. So I'm just worrying about that, and I was going to ask you about that.
Honestly, I don't know. I haven't seen the exam. I didn't even look at the practice exam. So I think, I don't know, because I know I can tell you from our exam, from when we took it last semester, that we had to write out the entire statement of cash flows, and like we had to create a balance sheet and like all that.
No, yeah, I was expecting that, but the circumstances have changed, so I'm just.
So I think my best advice is, because like you don't know exactly how the format is gonna be, do what you're doing and just like study the entire statement of cash flows. If he does tell you to write out one, I think that would be your best option. So you know where the numbers are coming from and you know how to create a statement of cash flows.
Okay. Well, would you think if I asked that question in the Canvas group chat, he would answer?
He's usually really good about answering. Or maybe you can just email him. He's
Yeah.
more responsive to emails. Yeah.
Okay. Okay, then I'll email him.
Okay.
Thank you, Minnie Mouse.
You're welcome.
Wait, Mauricio, are you the fluffy?
No,
Yeah.
no.
Are you what?
Oh no,
Be
because like
fluffy.
you changed his name. So
Oh yeah.
so moving on for the statement of cash flow, as I said, like this handout is mainly focuses on like the format of the entire statement of cash flow. So we already constructed the entire statement of cash flows for you guys, and right now we're just gonna have to fill them out one by one per section. And as you can see, there's like 3 sections for the statement of cash flow. It's gonna be the first section is it's the operating activities section, and the second, so we have the operating activities, investing, and cash flows from financing activities. And later, just do it later, Jenny. And so if you can see this like chart here, there's like some guidelines, because I know like from yesterday's sessions they're kind of confused on how they will figure out on when to like increase or decrease depending on like the transaction. And so can I control the cursor, Jenny?
Yes.
Yeah, just stop doing that first. So if you can see here, so this is like a general pattern for the operating activities. So if there is a if there's like a depreciation expense, it is automatically an increase to your cash flow, and decrease in current assets will count as add. Increase in current liability will also be added. So this will make more sense once we're doing the entire problem. And so for our net income, if you look at handout 6, at the bottom portion, it will give you like a brief like income statement type of thing. So here it says that your net income is 9,000. And so we're just gonna copy it here, 9,000. And for the adjustments for differences in operating activities, this is where this chart comes in. So if you can, if you look, so just remember that depreciation expense automatically will be added to your operating activities, because depreciation expense is not a cash transaction. And as I said earlier, what we're doing here is we're converting we're converting cash to we're converting accrual to cash. So we're just basically adding back this non-cash transaction. So depreciation expense. This is gonna be 4,000. And so you guys have any questions about why we added depreciation expense?
You guys get that?
I have a question. The note on the side where it says add and less, is that just for operating expenses?
Yeah, pretty much this like for operating expenses.
Okay,
I mean,
thank
for operating activities. Yeah, because like for operating activities, we're concerned on the current assets and liabilities. So if you can, if later on, you'll notice that what we're accounting for under this bucket is just like the current transactions, like current assets or current liabilities. All right, so moving on. If you look at the balance sheet, you'll see that from 2019 to 2020, the inventory decreased by 3,000, right? So since this is like a decrease in current assets, we're gonna have to add it. Decrease in inventory. $3,000. So in case you're wondering why we skip the accounts receivable and supplies part, that's because they didn't actually decrease. Like if you can see like from 2019, those accounts like increased by the specific number.
Is the 3,000 from subtracting 2019 from 2020?
Yeah.
If it was the other way around, where 2019 was 11,000 and 2020 was 14,000, would we still record like an increase in inventory?
Yeah, so that increase in inventory will go to this. We're gonna have to we're gonna have to less it.
Oh.
And so do we have other stuff? Yeah, so if we good, so we're good with the asset part because equipment is not really a current asset, right? So moving on to like the liability. So your accounts payable decreased from 11,000 to 4,000. So we're not really gonna add it because instead of keeping more money, we actually we actually spent more money. So instead of so what happened here for the accounts payable, we actually paid money to pay for those accounts to pay for those accounts payable. And looking at unearned rent, so it says here that your unearned rent increased by 1,000. So that means we kept more. So that means we kept more money. So unearned. And yeah, that's it for like for this part right here. Before we proceed to the next one, do you have any questions?
Hello?
Mm-hmm.
Oh, yes. I see there's more liabilities, but it says current liabilities. Would the current be under the one cycle period or 1 year?
Yeah, within 1 year.
Okay.
Yeah, and so okay, going back to the accounts that we skipped earlier. Since there is an increase in accounts receivable, so an increase of like 6,000, we're gonna have to put it here. Increase in accounts receivable. 6,000. And then the next account, which is supplies, there's also like an increase in the supplies. So increase in supplies. Which is 2,000. And Jenny, we pretty much covered the current assets part, right?
Yes.
Yeah.
So sorry, Raymond, I think you covered it, but why don't we put the accounts payable in the upper portion in the ad?
So so accounts payable is actually current liability. So if you since like your so like
Oh, so it decreased.
Mhm.
Of it decreased, so you less it.
That's
Oh.
it, yeah. So going to the current liabilities part, just this accounts payable, since there is a decrease in accounts payable, we're gonna have to less it increase in accounts payable.
So all the 6,000, 2,000, and the ones you're about to put for accounts payable, shouldn't that be negative, like in parentheses? Or okay, thank you. Just be clear.
That should be in the parentheses. 7,000.
I thought we had an increase in accounts payable.
Oh no, there's a decrease in accounts payable. So if you look at the balance sheet, so your accounts payable balance for 2019 is 11,000, and then in 2020 it became 4,000. So it decreased by 7,000.
Right. Thank you.
And yeah, I think that's it for accounts payable. Okay, let me just increase in Unearned. So we're just gonna have to get the total of the amount that we added and then that we subtracted. So it's gonna be
It'll be negative 7,000, right?
yeah, negative 7,000, and then just get the difference between the two. It's gonna be 2,000.
Where did we get negative 7,000?
So we combined this together. So 4,000 plus 3 plus 1 minus 6 minus 2 minus 7, which we get negative 7,000. Does that make sense?
And to be clear, do we have to label the cash flow from investing activities, and then the net cash provided by operating activities and all that? Do we have to label it, or can we just put the net income and do the add and less, or would we have to label each and every one of them?
Like I know when we're doing the statement of cash flows from scratch, that's what we had to do. But yeah, just to be safe, if you're supposed to do it from scratch, just make sure to label it correctly. Although you can like abbreviate it though. So
Oh yes, yeah, the abbreviate, but okay. So I should label it just be safe then.
yeah.
So the professor doesn't get confused or whatever.
Mm-hmm.
Okay. Then.
Yeah, so like when we did it, we had to do the entire thing, but your cash at the end of the year is, it ties out to,
The balance sheet.
yeah.
Oh no, yes, I understand that it ties down and everything, but just a waste of time for labeling every
Yeah.
activities and yeah. So,
Yeah, I
okay.
just like abbreviated like 2 or 3 words.
Hmm.
Just
As
make
long as you
sure.
know what it stands for.
Jennifer, Raymond, I have a question. I don't know if you guys know, but for our exams, since it's usually like some parts of it are written, do you guys have like any idea like how it's gonna be? Like if we have to like kind of like draw this out, like would we like have to type it or
Mhm.
how would we-
Actually, I actually don't know exactly how the format of your exam is going to be, but as I was telling them earlier, I would probably highly recommend that you still know like the format and like, yeah, the entirety of like a statement, just to be sure and be on the safe side. Because like, what if he does tell you guys to like type out an entire statement of cash flows from scratch?
Okay, cool. Thank you.
Yeah,
Mhm.
so
It
like
might
from
be like
what
a short answer.
yeah, like I think like from what I like for me, what would I expect is that if he asks you to like write the statement of cash flow from scratch, you can like possibly like just type the entire thing in. But if he doesn't do that, he might give you like a multiple choice answer to this part. Like for example, given this like information, what would be your net cash provided by operating activities? So
Yeah.
yeah, obviously you still need to compute everything, but you just have to present this answer. That's what I can like
Oh,
maybe expect from
I see.
when I do the test.
Or he can be like, what's your cash at the end of the year? Which
Yeah,
you
that's
should have to do then everything.
Then it will be.
yeah.
So just prepare for the worst.
So do you want to do the investing activity, Jenny?
Not really.
Okay. So for the investing activity, we're actually so here we're dealing with the long-term asset, uh, non-current asset. And so if you can see on handout 6, your non-current asset here is the equipment, and your equipment actually increased by 6,000 from 2019 to 2020. So that means you purchased new equipment, right? And so since you use cash for that, so we're just assuming that we use cash for this transaction. We're gonna have to put it here in the investing activity. So purchase or payment of equipment. I don't payment of equipment, which is 6,000. And so since this is the only account relating to this investing activity bucket, we can use this for like the total. So our net cash used for investing activity is
I have a question.
Mhm.
So we got the payment of equipment because the amount went up, right?
Yes.
So say for the exam, if the amount goes down, do we assume that they sold equipment?
Yeah.
And do we put that in investing or?
Yeah, so for that, you're gonna put that also in investing. So let's say, so this is just like, let me just give you like, so in case the equipment amount went down by 6,000, so we're gonna have to have sale of equipment by 6,000. So that's gonna be how you're recording it.
Okay, thank you.
Yeah, and
Can I
then
ask why the payment of equipment is negative 6,000?
I'm sorry.
Why is the payment of equipment negative 6,000? Because you had it in parentheses before, or was that just saying that we need to subtract it?
The reason why, just to clarify, this the one that I just did is just like an example, but the actual answer is here. Payment of equipment. Um, 6,000. So the reason why this is 6,000 is because we have to pay cash to buy a new equipment. So if you can see in the balance sheet, your equipment increased by 6,000 from 2019 to 2020. So we're basically assuming that we purchase new equipment for 6,000. So that's why this is negative, because we use cash.
Okay.
Mhm. And yeah, moving
Uh,
forward.
So sorry. So the investing activities are non-current assets.
Yeah.
Is that like assets that are non-current or everything? Like I do not understand the like.
Okay,
It,
so going back to what as you asked earlier, like current assets are within 1 year, right?
yeah.
So non-current asset, I was referring to like those, like for example, like equipment, buildings,
No, yeah.
land.
I just want to clarify. So it is assets, but just non-current, right?
Yeah.
Okay. Then you should put like a long or a like a comma after non-current. I'm sorry.
Yeah, long term.
So sorry. Yeah, because I don't know if it was just non-current assets, so just everything else, the long-term assets and long-term liabilities, everything other than non-current assets, or is it just assets that are not current? I'm just clarifying that.
Yeah, assets that are not current.
Thank you.
So Lanya has a question. What is another example of something that would go under investing activity? So like for example, like purchase of equipment for one, and also if you sold the equipment, or maybe if you like purchase like a building or land. So those type of transaction would go, those type of activities would go under the investing bucket. And yeah, pretty much like everything that involves like non-current assets, for example, like selling or purchasing new current asset, that would count under the investing bucket. Okay, so this is actually like a good question. So as I know that earlier I mentioned that if you sold the equipment, this would be like for um, example. So if you sold the equipment, this is gonna be your so this is gonna be your this is how you're gonna like account it under the investing bucket, right? Sale of equipment, and let's say this like X amount, X amount. And so let's say you had a gain from that sale. So what you're gonna do is you're gonna have to, actually, let me just double check real quick. This is like the tricky part. So okay, so since let's say you have a gain from this sale, which is not really a cash transaction, right? So gain, let's see, not a cash transaction. So what we're gonna do, we have to, so this gain increases your net income, right? Under, if you're gonna look at your net income statement, this gain would increase your net income. But in reality, if we're converting from accrual to cash, we're just concerned on the non-cash transaction, right? And so if this is the case, if there's like a gain, we have to we have to less it. So gain, because this gain is not, we didn't receive cash from this gain, right? I mean, we didn't not we so this, let me rephrase it again. So this gain is not actually a cash transaction. So this is gonna be like the amount from gain. Or, and let's say that if there's like a loss, then we're gonna have to add the loss back. Loss on sale. Does that make sense?
Yeah, thank you.
So let me just like leave it here, just so that you guys can remember. So moving on, oh here. So cash flows from financing activities. Financing. So for this one, it's best to just focus on the, so this concerns like the liability and equity part of your balance sheet. Liability and equity balance sheet, part of balance sheet. And so if you can see on the liability part, you don't really have any long-term liability, right? So you can just move forward to a common stock, which is it yeah, so here there's an increase in common stock, which means you issued more common stock in exchange for cash, right? Do you guys have any questions?
I have a question.
Mm-hmm.
What would be an example of long-term liability?
So for example, like earlier we're talking about like loans payable or like mortgage, right?
Mm-hmm.
That is an example of long-term liability because you have to pay for more than a year. Or for example, if you have like notes that that matures in more than 1 year, that also counts as long-term liability. I mean non-current liability.
Thank you.
Mm-hmm. And so if you can see like common stock increase by so common stock increased by 12,000. So we can issuance of common stock, which is 12,000. So in case you're wondering why we didn't make this as a negative, is because whenever we issue common stock, we're actually gaining cash because we're issuing common stock in exchange for cash. And so, okay, here's the thing for this retained earnings part. Never don't ever like forget, because it was like a common mistake for like statement of cash flow, is that they omit the dividends transaction. And so if you look at the retained earnings, this is actually how we're gonna get the dividends that was paid during that year. Oh no. So I created a mini T account here to reflect what's going on with the retained earnings. So like our retained earnings for 2019 was 19,000, and it had a ending balance of 27,000. And then from your income statement, so we have a net income of 9,000. So this is kind of like similar to like finding supplies expense or inventory that was used. So as you can see here, we have a total of 28,000. And so the question is now, how much did we pay for dividends to come up to this amount, to the 27,000?
1,000?
So it's gonna be 1,000.
Where did we get the 9,000 from?
So 9,000 is your net income. Net income. So if you can, I mean like, if you can recall like the formula of retained earnings. So to get the ending retained earnings, the formula is beginning retained earnings plus net income minus dividends. So this is how we ended up doing this, why we ended up doing this T account. So basically, like, dividend is equal to beginning retained earnings plus net income minus end retained earnings. Does that make sense?
Yes.
Okay. So to record to account this for this payment of dividends under the financing bucket, we're just gonna write down payment or dividend payments, dividend payment, which is 1,000. So since we paid cash, it's gonna be a negative number. And so for our net cash provided by financing activities, so add this together, we get 11,000. And to get the net increase in cash, we just have to get the sum, get a total of net cash provided by operating, investing, and financing activity. And then we'll get, if you add this, if you get the total of these three numbers, you'll get 7,000. And so just to check on if you did the right thing, if you get the right amount, you can go back to your handout 6 and look at the balance sheet, and it says there that your beginning cash, your cash balance for 2019 is 8,000. And so if you add this 7,000 here, the net interest in cash, to 8,000, it should equal to 15,000, which is what's reflected on the 2020 balance sheet for cash. The 2020 balance for cash. Does that make sense?
Do you mind explaining again the bottom part?
Mm-hmm. So we're done getting this 11,000, right? By we got this 11,000 by getting the total of this. So we got this number here, the 7,000. Let me just highlight this in a different color. No. So we got this 7,000 here by getting the total of 2,000 from cash provided by operating, 6,000 from the investing bucket, and 11,000 from the financing bucket, right? So we got this 7,000 here. And so just to check if you got the correct answer, you can go back to your handout 6 and check the balance sheet portion. So it says on the 2019 balance that your cash had a balance of 8,000, right?
Mm-hmm.
And so if you add these two together, you're gonna get, your answer should be the same as your balance with the 2020 balance sheet for cash. So which is 15,000. You guys have any questions?
Can you scroll up back
Mm-hmm.
to the investing part where you gave an example on the loss of a sale or gain of a sale?
Mm-hmm.
So you said if it's a loss, you add it, and then if it's a gain, you subtract it.
Yeah.
Okay.
Can you explain one more time how you got the beginning cash?
Oh, sure. So beginning cash, this portion right here.
Yes.
So for the beginning cash, if you go back to handout 6 and look at the cash account, it has a beginning balance of in 2019 it has a beginning balance of 8,000, right?
Yeah.
And so we're just gonna add these two together to check if we got the correct answer. So 7,000 plus 8,000 is 15,000, which is the cash balance from the 2020 balance sheet. So if you look at the cash account again from handout 6, under 2020, your cash balance is 15,000.
Oh, okay, I see. Thank you.
And yeah, for the cash basis, we just have to do this, right? We don't have to do the Oh, sorry, because I remember for handout 5, you have to do 2 parts.
Remind me of Handout 5 again. I already forgot.
It
Is
was the income statement and then the balance sheet. So we just had to do the income statement, correct?
for cash to from
Yeah.
statement of cash flows?
Oh yeah, on cash basis. Yeah, we just have to do income statement, correct?
Actually, for statement of cash flows, you have to use both balance sheet and income statement.
Oh, we have to use the balance sheet, but we just have to create or the answer is just the income statement, correct? Because for handout 5, I remember we have to do income statement and the balance sheet too. Like
Oh, yeah. We you just have to do this like you don't have to do any balance sheet at all.
okay. So I like cash better. It's easier. Just one sheet. All right. Thank you.
Mhm. Do you have a question, Mauricio?
Yeah. Um. Um. Would you or Minnie Mouse like to do my final?
As Jenny.
So would you?
I have a final. I don't I'm not allowed to do that.
Your excuse, I have a
Our
file.
careers on the line.
So our
This is recorded, by the way.
let it be recorded. I'm just asking a question. It doesn't hurt to ask. Just like how I'm gonna you hear this, Professor? I'm gonna write you a letter just with a few Benjamins inside to thank you for the class.
Yeah,
Hi.
with you, we'll definitely like since we're recording this, we can email you this video.
Are you gonna go over handout 5 again? I just got here.
You mean Handout 6?
Yes, that's
Yeah.
what.
Mm-hmm. So if you guys since there's like a couple of people that's just who just entered, so it's totally up to you guys on what we on what we want, if you want to cover for this like tutoring session. We already did Handout 2 earlier, so if you guys are comfortable with that, we can totally do the Handout 6 all over again. But yeah, let me just get the consensus of everyone.
Well, I'm out. Thank you for all the help. Thank you, Minnie Mouse and Raymond.
Thank you for
Good luck.
joining. Good luck.
Thank you, guys.
You're welcome.
Thank you for joining. Good luck.
Thanks.
Thank you, Olivia. I think we can was that Mitzi who asked whether we can go over Handout 6 again?
No, it was me.
Oh yeah, Sophie. Oh wait. Sorry about that. So yeah, we can definitely do the Handout 6 again.
Awesome.
Let me do some. Let me just type something to, Let me just delete everything so that we can start over. So I think we can start handout 6 again. And so for handout 6, as what I've mentioned earlier, if you recall on handout 5, you did convert everything from cash to accrual. So for handout 6, we're just doing the opposite. We're doing accrual to cash. And so like the purpose of this statement of cash flows is to reflect your cash transaction, or like the inflows and outflows of your cash account. And so for this statement of cash flows, what we're doing is we're just adding back all those non-cash transactions and subtracting all those like cash transactions. So to give you more clarity, I did this mini chart right here for that. This chart right here is related to the operating activities bucket. So just so you guys won't get confused later on. And so like in statement of cash flows, there's three sections. There's like operating activities section, investing activities, and financing activities. And so I know this this handout it's more like following the format of the statement of cash flow. And so what I would advise for you when you're taking the final is that to really get yourselves familiar with the format of the statement of cash flows, because when we're taking this test, we actually had to do the entire thing from scratch, and Professor Weiss didn't give us any template at all. So it's really effective for you to uh, not just memorize the template, but also like understand what's going on. And so since we already wrote down the template, we're just like filling in like numbers and like filling in the transactions per bucket. And so for our net income, if you look at handout 6, you'll see that handout 6 gave you like two financial statements. The first one on top is your balance sheet, the comparative balance sheet from 2019 and 2020. And at the bottom part of handout 6, there's like a mini section there, which is your income statement. So if you look at the bottom, it says that your net income is 9,000. And so we're just gonna copy that amount here. Net income 9,000. And so for the next step, we have to account for the adjustments for the differences in operating activities. So this chart right here is where you can really like use this chart right here, so you'll not get confused, because like from yesterday's sessions, a lot of students are asking when they'll figure out when to like decrease or when to add or subtract depending on the like transaction. So here's like a tip for you. So for operating activities, you're dealing for the most part, you're dealing with current assets and current liabilities. And so as you can see in this chart here, if there's like a decrease in current assets, you're gonna have to add it back. And if there's like an increase in current liabilities, you're gonna have to also add it back. And like the two like accounts that aren't really like current asset or liability is the depreciation and the loss or gain from sale. And so if you see this like depreciation, it's like the default, you're gonna have to add it back to the operating activities block. Okay, so depreciation expense. Since depreciation is not really a cash transaction, we have to add it back to the net income since we're converting from accrual to cash. So depreciation expense is 4,000. And so this amount was taken from the income statement on handout 6, just in case you're wondering. And so do you guys have any questions about this before we move on? I guess we can move on. So for the next step, as you can see on the balance sheet, for the current assets part, your accounts receivable increase by, so your accounts receivable and supplies increased while your inventory decreased by 3,000. So if you look at this chart, since inventory is a current asset and is a current asset, so decreasing inventory, you would have to add the amount back. So decrease in inventory. And to think of it, just we're just assuming here that when you decrease your inventory, you're actually selling more. That's why you're gaining more cash. So that's basically like the assumption behind this, is that since there's like a decrease in inventory, that means you sold more to your customers. You were able to sell this amount to your customer, 3,000. And so we already accounted for. Okay, so if you look at the liability section of the balance sheet, it says that your unearned rent increased by 1,000. So since this is an increase in current liability, we're gonna have to add it. So increase in unearned rent. So by 1,000. Yeah, so right now we're just doing it step by step. I know we're skipping some of the accounts, but we're gonna go back to them after we finish this. And I think as far as like current liability, that's it. And so we're gonna go back to our current assets. Earlier, we know that our accounts receivable increased by 6,000. And since accounts receivable current assets, we're gonna have to less it. So increase in accounts receivable. by 6,000. And also the same thing for supplies. Your supplies increase by 2,000 from 2019 through 2020. So increase in supplies, increase in supplies. So basically here we're assuming that since we're assuming that we purchased more supplies from 2019 to 2020. That's why we paid, we're assuming that we're paying cash from those supplies purchased. And for your accounts payable, here it's showing that your accounts payable decreased from 11,000 to 4,000. And so decrease in current liabilities will be less. Will be subtracted. Decrease in current liabilities. Oh, just to keep in mind, you can actually to indicate that that you're subtracting it, you can put the parentheses here. And so you just have to add everything to get the total of this one, which is 7,000, negative 7,000. And this amount will be subtracted from the net income. It's gonna be, so this one subtracted to this one will be 2,000. So your net cash provided by operating activities would be 2,000. Do you guys have any questions? Please respond to the chat box. So. I think we're good. So moving on. Yeah. So moving on. This is our We're now gonna move on to the investing activities. And so for investing activities, what we're dealing here is the transaction when it comes to non-current assets. So non-current assets may include current assets such as equipment, building, land. Yeah, so those are some of the examples of non-current assets. And so here on handout 6, it shows that your equipment increased by 6,000. So we're assuming that we paid cash to gain a new equipment from 2019 to 2020. And so to account for this transaction, we're just gonna put payment for purchase equipment. So this is, since we paid cash or we spent cash, that means there's like cash outflow. So I have to put it as negative 6,000. And since this is the only non-current asset in this balance sheet, we don't really have to record for anything. except then the equipment account. And so we can finalize the total. So your net cash use for investing activity would be negative 6,000. Does that make sense?
Yes,
Okay, thank you.
you're welcome.
And so for the cash flows from financing it, so now we're moving on to cash flows from financing activities. So for this one, like a tip that I could give you is just to focus on the non-current. It's just to focus on the non-current liability part and the equity part of your balance sheet. And so, examples of non-current liabilities are mortgage payable, long-term notes, or loans payable. So basically, any liability that can be that will be paid for more than a year counts as non-current liability. And so far for this balance sheet, we don't have any non-current liability because accounts payable and unearned rent is due within a year. So we can just focus on the common stock and the retained earnings. So for your common stock, as you can see, it increased. Your common stock increased by 12,000. So whenever you issue, so just remember this, that whenever you issue common stock, you're getting cash in exchange for that issuance of common stock. And so you're actually gaining cash for this issuance. So issuance of common stock would be an increase in cash by 12,000. And the next step, which is like which most people always like forget to do, is the payments of dividends. And so for like dividend payment, it's really a good, like for me, what works for me is to make a T account to get an overview of what's happening in the retained earnings. So as you can recall, to get the ending balance for retained earnings, we have to account for the beginning retained earnings plus your net income minus dividends, right? And so just like moving around the formula, we get dividends equals beginning retained earnings plus net income minus ending retained earnings. So to give you like a better visualization of what's going on, from handout 6, it says that your retained earnings for 2019 is 19,000, right? And for your net income, which is we already figure out here, and also if you'll see in your income statement on handout 6, your net income is 9,000. And so the next step is figure out the ending balance for the retained earnings, which is 27,000. So basically, is your net income. And so what we're doing here is we're finding the amount that can be that will be subtracted to the total of these two numbers, so that we can get the 27,000. So like also like referring back to this formula, we can see that your dividends is 1,000. And so since we paid cash for this dividend, where can I? Dividends. cash. Since we paid cash for this dividends, we have to account this for the financing activities by subtracting 1,000. And so under net cash provided by financing activity, getting the total of these two numbers, we get 11,000. Yeah, and so to get this net increase in cash, we just have to get the total of the numbers from the three buckets. So for net cash provided by operating, we got 2,000. For investing, we got negative 6,000, and then for financing, we got 11,000, which totals to 7,000. And so this is your net increase in cash. So to double check this number, to double check whether you get the correct number, you can go back to Handout 6 and see the balance, see the 2019 and 2020 balance for the cash account under your balance sheet. And if you there it says that your cash had a balance, had a 2019 balance of 8,000. And so since this is your net increase in cash from the two periods, such as like 2019 and 2020, if you add this together, the number should equal to the cash balance from the 2020 cash balance from Handout 6. So here, you know it's right, it's correct, because your 2020 cash balance from Handout 6 is also 15,000. So yeah, that's how you can check whether or not, whether you get the correct number or not. And so just to keep in mind that although you get this, that you got this number correctly, it doesn't mean that the amount that you got per bucket are the numbers that you got per bucket are correct. So just to make sure that whatever transaction that you're accounting for each bucket is correct, because from what I remember from my previous test is that Professor Wise would grade heavy on this like numbers per bucket rather than just getting like the total amount. So yeah. Where did you get
That's
the one?
all it is. It's just the three, like the three sections, and then you find the net increase or decrease in cash.
Yeah.
Okay. Thank you.
Mm-hmm. Yeah, because I think like since everything now is online, what I can see him doing in your test is that maybe he'll ask you, like, for example, given this like information, what is the net cash provided by operating activities? So you have to really get your numbers correct in order for you to get that correct answer. So Susie, where did you get the 1,000? Okay, so for the dividend payment of 1,000, so if you look back to this formula, you know that to get your end retained earnings, you have to add beginning retained earnings plus net income minus dividends. And so just by moving around like the formula, we get dividends equals beginning retained earnings plus net income minus ending retained earnings. So I know this is kind of like formulaic, but just to give you like a better visualization of what's happening, if this is like I just constructed here like a T account for the retained earnings. So if you look at Handout 6, your retained earnings for 2019. So your retained earnings for 2019 is 19,000. And for 2020, your retained earning balance is 27,000. And so when calculating this end retained earnings, you have to account for the net income, right? So from the income statement, your net income is 9,000. And so this two amounts here, which totals 28,000. So you have to, so from the 28,000, you have to find a number that would end up, that would equal, you have to find like a number that would make this 28,000 to 27,000. So you can do that by subtracting, so 28,000 minus 27,000, which is 1,000. So that's how we got the 1,000 dividend payment. Does that answer your? You're welcome. Do you guys have any specific questions? Yeah, if you guys have any questions, if you just feel free to type it in the chat box. But yeah, I mean, pretty much for a statement of cash flows, as I said earlier, it's just like, for me, it's just a matter of memorizing the format, and also like understanding like what's going on, because I know like for your finals, there's like a lot of stuff going on, so it's better to have that like easy part out of the way. But yeah, definitely like also like focus on the multiple choice part, because I think that's the hardest portion. That's the hardest portion for me when I took the test. And I know that Professor Wise grades heavily on those like multiple choice. So it's either like you get the credit or no credit also. That's really crucial to also focus on those on the multiple choice part. Yeah, we can definitely schedule individual tutoring sessions. But so what we did since the lockdown is that we didn't actually we just actually schedule a tutoring session depending on the students' availability. And so depending on the tutor's availability next week, we can schedule one-on-one tutoring. But well, yeah, just feel free to email us your availability, and we'll work things out. Hopefully, there's like tutors available, because I know next week is also like our finals week. So hopefully we have availability for next week. Let me just write down the. If none of us are available for next week, I'll also let me just pull up other like resources that could. Jenny?
The accounting and IS department is also offering tutoring sessions. I'm not entirely sure like what their availability is like next week, but there is a link. I'll post it in the chat. You go to that website and then they have like I think time slots that you can sign up for.
Yeah, and also maybe Jenny, you can post in the discussion the link for those like the emails for those tutoring links.
Oh yeah, I have.
So they can like everyone can refer back to like those resources.
If you go to this link, I think there is like, oops.
No, you send it to me right.
There you go.
Thanks, Jenny.
And then this is the email if you have any like questions or, oops. Wait, did I send it?
I don't think so.
That's the email that you would like ask questions to, like if they don't reply back to you or something, and then just email them and ask. That's the accounting and IS department email. And then if it's okay with everyone, we're actually gonna take a 10-minute break. So we'll be right back.
Thank you, Susie. We'll be right back.
Thank you. Good luck to you too.
Maybe I could just like mute this, right?
Yeah, just mute. Raymond.
Yeah. It's
You
gonna
can-
be.
You can stop recording too, so just
Oh yeah.
yeah.
Stop recording.